Pal, Davis Michelson here. We have a very special guest host today. I now relinquish control of the big green leafy microphone of AgriTalk to Mr. Brian Splitt. Brian, take it away. Bring in your guest.
Davis, thank you very much. Yeah, so we're going to have Ben Wiginton on, and I've known Ben for years through Twitter. He's always provided some great insight to the market. So Ben, thank you for being on. And maybe just before we get talking about the market and whatnot, can you just give us a quick synopsis of your role in the marketplace currently?
Sure. I'm the director of commercial sales for AgYield. I'm a broker. I work directly with some of our clients in the Eastern Corn Belt, advising them on grain marketing. And I work with our commercial partners and things that we do with them as well.
Okay, perfect. So you have experience on both sides, what we would call the retail side, which is working directly with the producer, and also working on the commercial side, so the end user side. And so in preparation for the show, we talked about maybe some of the topics that we thought were important for listeners to hear. And I think we've obviously had a lot going on over the last 96 hours or so. With some of the bank conversations, shutdown of Silicon Valley Bank. Hard to really know where we're at from the fund perspective, and why is that?
Well, delay in getting COT data out to everyone from the ION hack, and it's been kind of a frustration from personally for a long time. I feel like it's something that should be daily, and now we're a few weeks behind. And I think that becomes important when we have an event like we saw over the weekend, and it's really hard to gauge what a risk-off environment really means. And, if you were looking at fund length near records and we have something like this, we could have had a much greater impact. But seeing how it happened after a 60, 70 cent break, I think it was slightly muted. And it looks to me like a lot of the markets kind of led the information that they knew something was going. I kind of hope that was some of the aggressive selling that we saw in corn and wheat. So I think that commitment of traders just is a really good sound ledger to let you know which side of the boat people are on. And risk off is such a difficult thing to gauge sometimes. We spend a lot of time trying to analyze markets and go through all the different scenarios and kind of war plan it, I would say. And in this event, you're taking a major component out to figure out, which way do you want to lean. And it's one of those things with the banking, it could wind up being quasi supportive to grains if we see the dollar continue to break. Certainly concerns with crude oil, but cross contagion, nothing happens in a vacuum. And if it's really bad and continues, we know what can happen in that environment. So not knowing the full count of the cards at this point with the COT with an event like this is kind of frustrating.
It is. And to your point, if you're a fund manager and you say, hey, because of this event, we're going to cut our exposure in ag by 10% or 25% or a third or whatever the number is, there's modeling where you'd say, hey, for corn, every 10,000 contracts that is bought or sold may move the market by X amount. And we just really don't have a way to gauge that right now because we have no idea where the funds are. And you could try to track it as best you can, but the data that we have is several weeks old. And it is frustrating because I'm of the same belief as you, where with technology these days, I think you should be able to get a day-to-day report of the activity. So to have the data that we have right now, as old as it is a very frustrating thing. Like you said, especially when you have a major event like we've had happen here recently. So moving on, one of the things that we've seen here is during the month of February, we had the average price for crop insurance set. That was at $5.91 for December corn. And we have come down quite a bit below that level. So what do you think is important for the producer to consider because of that?
I think that they need to look at the value as opposed to the price of what some of the crop insurance products will bring for them. It's an incredible tool. And I'm not a licensed crop insurance guy. I'm not trying to sell anyone. I'm not selling it. But from a trader's perspective, it really is a phenomenal tool to market against. And because we broke so far off the spring price, it makes a lot of the crop insurance add-ons definitely worth your time to go through with your agent, whether it's buying up your RP, looking at ECO, looking at some private policies like some bands and things like that. You cannot reproduce those types of revenue puts in the market, and the value to them right now is tremendously high because they're pricing those off of a 591 spring price, and you couldn't come close to raising the floor that you could in the market right now. So I think having a good agent and talking through with him and your advisor to look at the value and the risk transfer component of it, especially as we're kind of peeking over the horizon to where we're getting into some break even to negative territory, and I think the value of that is what people should focus on, not necessarily price. And I'm not trying or espousing to spend someone's money, but the American producer is a pretty savvy business person, and they know what value is. So I think looking at that component of as opposed to price makes a lot of sense, and they still have some time to go through that and consider it. So that I think that has been really for us over the last 2 weeks a focus and discussions with our customers, and then certainly things that you can do around that to try to offset some of the cost and keep yourself in more of a balanced profile.
So with that in mind, as we kind of take into picture the totality of some of the tools that are available to the producer, whether it's crop insurance or things available on the board, are there things that you are looking for? Let's say maybe in the next 2 weeks, we do have a major report coming up where the planting intentions and the quarterly stocks are going to be released. Are there conversations you're having specifically with certain line items with producers right now that you think are worth noting?
Well, I think this is, it's in its most simplest form, and everyone who's worked, whether it's been in the commercial space or in the retail space, I think this is an environment where, last year, if you had in working orders, a lot of the times you got punished for it because within 2 weeks or 10 days or 2 hours, you were 20 or 30 cents higher. So it can kind of dictate your strategy on those things. But with reports, with data dumps, I think it's imperative that you have something in there, if nothing else, for a reminder that, hey, we just got to an area that we were willing to look at and makes a lot of sense. And then, whatever strategy you decide from that point is your preferences. But I think that's important. We've been trading some really, really big acreage numbers in corn. It feels like maybe it's leaking out just a little bit. But I think we've priced a lot of that in for now. And, we hit those seasonalities. I was listening to you guys earlier talking about wheat, and it's wheat's such a silly beast, and we always talk about how many times we have to kill it before we harvest it, and we haven't had a killing event yet this year. And whether that sounds somewhat cynical or not, we have all those sorts of things on our horizon. I look at performance that needs to take place in the U.S. on a crop. The safrinha crop's getting pushed back 20+% of it. That just pushes that further back into their dry season. And certainly we've become muted on Ukraine, and we saw at 680 and no export business that we had a very tempered response in markets to any sort of headlines that came out of there, which was very counter to what we'd experienced a year ago. Potentially today we at 70 cents lower and doing some business, maybe that starts to matter a little bit. And I do think that for old crop, at least, we were going to have to see some performance on all these crops that are budding around the world in order to finally put a nail in this coffin. And I feel like everyone wants to trade this big carry out today. And I understand that we trade a futures market, but we still have a lot of hurdles to overcome before we're really comfortable again, especially domestically.
Yeah, I agree with all that. It's amazing that the USDA has dropped export demand as much as they have, and we're still at about a 1.3 billion bushel carryout. But we're going to take a quick break. We can pay some bills here, and when we return, we're going to hear more from Ben Wiginton of AgYield.
I think we may have time for one more question. If you want to, we got about a minute left. Do you want to ask one more question? Yeah.
Yeah, let's ask another question.
Get started on something else.
Okay, so weather-wise, there's not a lot going on domestically for weather, but it's starting to perk up a little bit. What do you think the trade's going to be looking at for weather right now?
Well, I think that we definitely, when you look at the things that were supporting the drought maps here for a while, and they were legitimate, right? There was reason it was dry in a lot of places. And I think that we took a lot of edge off that, and that kind of led to us getting stymied up above. and then potentially selling off. That risk proposition that managed money is willing to take starts to get a little bit more muted as those maps become clearer and clearer. Now, I think that
there we
out
go.
West.
Yeah, now we need to take the break.
Now we'll hop out.
Go. There.
Yeah, you got
We're
it.
going to have another little bit of weather conversation when we get back with Ben.
Back to Brian Splitt with a conversation with Ben Wiginton from AgYield. Brian, take it away.
Ben, so before the break, we were talking about weather domestically, and you had talked about some of the replenishing of the soil moisture profiles. And so one of the things that I think the trade is starting to take note of is just how much snow we have up north. And there's a crop that is fighting for acreage right now, and that's the spring wheat. And I think that could be a positive story moving forward, where we haven't really planted less than 10 million acres of spring wheat domestically in history, and if you use a record yield, we're still looking at a potential very tight carryout. So I wonder if that might be something that helps support the wheat moving forward, especially as we get a little bit deeper into the conversation of this grain corridor.
Well, I think that wheat in general it's fundamentally it's got a pretty supportive balance sheet, and you have that working for it. I think it's still really dry in Kansas and the Central Plains, and wheat's a wonky crop, right? It can really wear you out over a period of time before it's ever any good. And we saw in 2008 what can happen with spring wheat when it gets off its rockers. And wheat, a lot of people will probably disagree with this, and that's okay. We're all entitled to our beliefs, but wheat a lot of times can be the canary in the coal mine and kind of lead people by the nose around in markets, whether that's factual or my hallucinations. But I definitely think it's something to watch. Those are all relevant problems domestically that we don't have a lot of answers for. And wheat is the crop that, we saw it last year. We've seen it a few other times, that it can really get unhinged when you talk about a direct food consumptive commodity. And I think it's definitely something worth keeping an eye on. I struggle with whether this far out, but wheat is the one that can really get goofy. And we can be cynical and talk about killing wheat, but we have had some major weather events that have been problematic for wheat over the last 20 years. And with the tight balance sheets that we see there, I think it's something to keep an eye on. SRW, I think is going to be really good. I think there's going to be plenty of it. But again, we've got to get to late June, early July for that. So.
Right. So maybe the takeaway here, and one of the things that we've seen over the last several months is because of the dryness out west, HRW has outperformed SRW. And maybe it's the spring wheat turn for a period where we start to see spring wheat outperform winter wheat due to these concerns. But we had some positive price action in grains today, which it's been a while, but we've got very negative trade today in the energies. And namely, you look at crude oil on the April contract, which is going to be going off the board here in about a week. But we came down to these December lows. Are you concerned about energy values? Are you concerned about how that translates to the grain market?
I am. I think that macros become that cloud that's kind of following us around. And we've so far, for the most part, we've been able to kind of stand on our own 2 feet because of some tight fundamental situations. But it does bother me. And I look at markets that have not had that same staying power. Cotton and natural gas come to mind. Crude oil is another one. And when it was over there, it was over. The grain market has continued to give us opportunities, which we've been grateful for, right? You can mess it up and still get a chance to reward some better pricing. And I think that we have to remember that if we come around this time and everything gets off to a good start, everything feels good with new crop, that could be our potential path. And in those kinds of markets where we typically get relegated to, 7 to 8, 10% type of rallies, and wherever that comes from, no one knows. But caution, we talked earlier about crop insurance, just kind of going back to that and expanding on the macro picture, that we've been given multiple opportunities here. And I think this is worth saying, because we started off talking about crop insurance and people spending the money and raising their floor and giving themselves some protection, which in the short term, I think could be somewhat supportive to grains as people feel a little bit more at ease. They've bought themselves a little more protection. I think generally financially they're in good shape today. But should we start producing a large crop and people still aren't marketing, you could out yield your coverage on the way down and have a year someone like 2014 where we just keep breaking and no one wants to sell. So, my advice would be make sure you understand, have the best grasp you can for your customers and for your farm on where your yields are at and where your crop insurance is actually at, because you can work your way out of coverage. So I think those are important things as we start to tie in weather and kind of the future thought of where we could go here, because I don't, last year we had a really pretty, I think, unique situation. Seasonally, it was in line with breaking like we did into the middle of July. But at the same time, anything that was following on yields was telling us that our crop was getting worse and worse. And we had a phenomenal recovery and gave people a really good chance to get caught up and do some things on their 22 crop. So there's certainly a lot of balls in the air. I'm curious what, our markets have really turned from a technical perspective. And you and I have traded some insight on charts before. There's no denying that they have turned negative over the last 10 days to 2 weeks. And I'm curious on your thoughts, if you think that's sustainable, or, as a producer, what should they be looking to sell rallies on new crop now, or just in general, what your thoughts are?
Right. So you brought up a previous year, which was 2014. And I think there's been a lot of talk in the industry about the year prior to that being 2013, being a potential analog for 2023. And there are some similarities when you think about, in 2013, the high for the December contract was made the very first trading day of the year, which is what we've done with these 23 thus far. You think back to where we were at the beginning of February in 2013 as we set our price average for crop insurance, which ended up, we started the month of February that year at 590, and that's about where we were this year. I think 595 was the settlement, the first trading day of the month. So I see a lot of similarities between 2013 and 2023. And so if we continue that path forward, we did make some lows in 2013 around the WASDE report, which thus far, if we can hold last week's lows, would also be the case. So I'm looking for a little bit of a push higher over the next couple of weeks. We had a double bottom on December corn at 583 3/4. That was the low that was made on the January report. And then we made it about 10 days later at the same price. And when we took that low out, we really saw a large break. So I'm looking for a move back up towards that 580 area as a place to maybe do some catch-up sales if you feel like you are under-marketed. Maybe at the very least add some put coverage prior to the planning intentions. Because if we do follow suit, that planning intention report might be the impetus to push us into a level of new lows afterwards. And we do have to realize that this market is trending lower. We've been in a downtrend since spring of last year. So that is my concern. And likewise, I think for beans, there's maybe a concern that the acreage could be inadequate. If that corn acreage number comes in high, that likely means the bean acreage number is lower than what we might need. And I think we could see the beans recover from here, especially after today. We came within about 2 cents of those lows on the November contract that were made back in January. So hopefully we can see some support here and float higher. Do you have any price targets that you're hoping for on both new crop contracts?
Yeah, I do. For starters, I definitely think that 580 to 583 is an area where it's kind of a crossroads. It kind of correlates with the lows of the extended range that we had going back to early December all the way to the breakout. So I think doing something there makes sense, even if it's just being defensive. I think it makes a lot of sense. And then figuring out for yourself what, where you're at mentally on what it's gonna mean to you. Some guys, they have that problem of missing out on a higher move. I'd look into something like a a min-max or an accumulator through a commercial where you're going to have something that's going to reward you higher. But I think it's an area where on the chart where you execute something. And again, I think that goes back to the individual preference. Volatility has been cheap enough that puts start to have a little bit more appeal. So yeah, I don't disagree with that. I would love to see us push through there, go up and challenge 6 to 618 again. I think we're going to have something that is negative towards potential supply for us to see that.
I would agree. And you said something about what it means to you, and I'd like to touch on that when we get back from the break. And we're going to cut out here for a few minutes and revisit that sentiment.
Still more ground to cover here. Brian Splitt, take her away.
Thanks, Davis. So before we went to break, something that Ben had mentioned is the idea of what it means to you. And I think I know what you're saying, Ben. And to me, the idea is, hey, $6 corn is not the same for everybody. If you're a producer in the Northern Plains, that might be different than a producer in the Eastern Corn Belt, which could be different for a producer out west near feedlot country. So what do you think is important when you talk about the idea of what it means to you?
Well, I think it goes back to the individual nature of every person, their cost structure, their risk tolerances, where they're at in their life. And we've had multiple years of really, if not record, near record margins, and complacency has been the winner, really, by waiting. And I think the environment is changing, and we saw this repeatedly coming out of 2012, where there was a preponderance, whatever it is, predilection to go back to $7, $7.50 corn as the number. And we have to remind ourselves that we're in a margin-based business, and price is relative to cost when you make money. So I think knowing those numbers and then applying the strategy for you that makes sense and being able to do it in an informed way is really the key to long-term year-over-year profitability. And this year, we gravitate back to those things that made us feel good. And being a former floor trader, that's a chemical and an emotional reaction as much as it is anything else. And you can have really euphoric feelings when things are going really well and you're doing well, and you can have really negative, kind of paralyzing feelings when things get going really, really bad. And I think the key is to find the medium there and realize that you're not a trader, you're in a margin-based business, and you're forced to have to deal with these markets as a component of your business. And when we led into this, we were talking about macros, and a year ago we had crude oil trading near $100 a barrel, $90 a barrel, whatever it was. It's quite a bit off that right now. And all those things have changed. The inflation tailwinds, we're doing everything we can to curb inflation. It's not being let alone or fanned anymore. So a lot of those tailwinds that were driven over those things, and we certainly feel like we've kind of muted the Ukraine risk for the time being. So it always goes back to margins. It always goes back to where am I making money, and then being able to apply the strategy that best fits that person at that place in time. And I think that over time, it pays.
Yeah, I agree. It's something where it's extremely important to really realize where we are from a cost of production standpoint this year, because February price average for corn at $5.91, and it feels great. Hey, the average price last year was $5.90. It's the same. But the cost to grow a corn crop this year compared to last year is substantially different. So this will be the most expensive crop to grow for corn that we've seen. And I think it causes me to feel like we need to be much more defensive than last year, especially because we aren't seeing an uptrend in the market like we were a year ago. We are now trending lower. I look at a continuous chart for crude oil, and it's wild. You look at the high that was made in March of 2022 on front month crude oil is $130.50. And right now, the front month contract, as we speak, is sitting at $71.50. That's a big change in values on the energy side of things.
Yep. And all those things, we are not immune to that sort of disproportionate pricing. And, right now, I think we're holding our water pretty well. So there's an acceptance and humility that we could see a fair amount of downside once we secure a better feeling and a better grip on new crop supplies across Ukraine, South America, and of course the US. So yeah, I think that you have to be defensive here. I do think there's some potential to see another little round of old crop firming up and some better opportunities there. We saw a lot of grain, and I'm speaking particularly for the Eastern Corn Belt, and I think it was for the most part nationwide. We saw a lot of grain move in December, January, February, March. Processors recovered all the way out through. We never really saw a big basis push, probably half of what we would normally see this time of year. If you look at the transportation markets, it looks like there's some bids out there in June, July that would suggest higher levels. But I think that the coverage is really slack beyond March. So I think there's opportunity here still, maybe in the old crop, to drag us up and give us a little bit of a lift, and hopefully it gives us the opportunities it would like to reward that.
Yeah, I think my sentiment here recently has been, if you want to be bullish with something, maybe be bullish with what is in the bin, and be much more aggressive with what we are looking at as far as producing this year, because we really can't afford to screw that up if we do continue to see the commodity markets as a whole start to trend lower. And I watch some of these commodity indices, the Bloomberg index, the Reuters index, and the commodity indices as a whole had some good, strong lows made in July. We bounced. We had some good, strong lows that were made in fall. We had more of a meager bounce off of that. And then since then, we've kind of taken out those lows as a broader based index. And to me, that just suggests that we are no longer trending higher in commodities. And it reinforces that we are now in a downtrend in commodities. And I think producers need to be mindful of that. If you're trying to not fight the trend, then you have to recognize that.
Brian, I'm going to hop in here and thank Brian Splitt, thank Ben Wiginton from AgYield. We're almost out of time. Brian, excellent work today, man.
Thanks. It's weird being on this side of it, but I enjoy it.
I'm glad. Come back tomorrow morning for more AgriTalk, everybody.